Delighted to be here. So I'm one of the co-portfolio managers of the JPMorgan UK Small Cap Growth and Income Trust. I've been at the firm for 11 years or so, managing this trust alongside Georgina Britton, who has been running this trust for north of 25 years now. We've put together a few slides, and the first section is really just detailing the case for investing both in the UK but also UK small caps and why we think it's a particularly exciting time to do so. I'll then run through the fund in a bit more detail on how we invest, some of the new positions and some of the recent sells, and a bit of an outlook on the coming years. So I guess just to step back a little bit, and we've heard from Alex just in terms of how well markets around the world have been doing. I think it was worth reflecting on the longer term performance of parts of the UK market. So the benchmark for this trust is the Numis Smaller Companies Plus AIM. About 50% of that is within the FTSE 250. So we've put this chart up, which just shows you the long-term performance of the FTSE 250 against a number of other global indices. And the FTSE 250 here is in yellow, and as you can see, it has been one of the best performing indices over the last quarter century. And whilst in recent years it's obviously lagged the S&P 500, and we'll come on to the valuation picture, there have clearly been a lot of reasons behind that impacting the UK perhaps more specifically that we now think are actually turning, and we think the outlook for the UK is looking much more positive. So the long-term picture is incredibly strong and favourable for the FTSE 250. I think a number of reasons for that. You have got high growth companies in this part of the market. You've got some very high quality management teams as well. And there are opportunities obviously in small and mid cap stocks to expand into new products and services, expand into new geographies, and that growth runway can be incredibly strong. Just onto the valuation picture on this slide. So this is the relative equity valuations versus the US and Europe, and I'm sure you've heard it from many presentations in the last few years in terms of how cheap the UK is relative to other markets, and that picture has continued for many years. You can see that started in around 2016, but that has continued, and that has left the UK in particular at a very large discount to other markets. That said, we still do have a number of companies here who are very internationally exposed, similar companies to those you'd find in the US or Europe, very similar operations or regional setup, yet are just trading at these huge discounts to other regions, which we don't think is sustainable and we think will certainly revert over time. Just onto the macro picture as well, and I think you read all the headlines and it's very doom and gloom, as tends to be the way with a lot of media publications, sadly, these days. But actually, the underlying picture for the UK economy is relatively healthy. The UK in the last 6 months is a standout globally in terms of macro data surprising on the upside relative to expectations. It's in stark contrast to the US and Europe, where actually macro data is surprising negatively. We had another good example of that this morning with the services PMI coming in again above 50, but also above market expectations. So that trend has been going on for 6 months or so. You can see some of the key data here, and this is some of the macro data that we look at on a weekly basis. In the top left, the consumer confidence figures, which were obviously down in the doldrums a year or two ago, but have rebounded very strongly in recent months or over the last year, particularly the indicator for future personal finances. You can see there almost reaching all-time highs, which is not what you'd expect given the media headlines, as I say. UK inflation bottom left, again, we're well within the pack now. Not saying it's the end of worrying about inflation, but actually seems to be much more range bound and certainly under control. And it'll be interesting to see if the Bank of England do pull the trigger on interest rate cuts sooner than their counterparts around the world. And I think that typically the first interest rate cut is typically a very good catalyst for small caps outperforming the rest of the market. So we'll wait and see on that one. The household savings ratio in the top right, this is a really interesting chart in terms of how much UK consumers have been saving since the start of the pandemic, and we all expected that to revert to normal levels. But UK household savings ratio has remained incredibly high, and accumulated savings in the UK market currently worth 16% of GDP. That's from the start of COVID to now, 16% of GDP, versus the US at about 4%, and that number is falling. Europe is around 8 or 9%, and again falling. But the UK savings ratio continues to be incredibly high. Some of the savings have been used to pay down household debt, which again is in a very strong position relative to history, and the savings actually now matching the amount of household debt. So there is potential for significant consumer spending in the UK economy. Again, the PMIs, which I referred to earlier, have been trending above 50 for some time, and again a standout really in the G7 as well, and that tends to be a very good lead indicator for the economy as well. Outside of that as well, I think there are a number of other factors. Real wage growth is rising and is amongst the highest it's been for a number of years now. Clearly, there's a rather bigger event happening tomorrow, and I think looking at the polls, the predicted result has been priced into markets a long time ago. So I'm not sure our political situation is any worse than what we're seeing in other parts of the world, the US, Europe, etc. Perhaps just having some stability of government will give investors confidence to start looking at the UK market again, because outside of the macro data in terms of investor allocations to the UK, that has been falling significantly for many years now. Pension funds, we think, are actually below index level in terms of their allocation to the UK, so they're underweight the UK in terms of their portfolios, and just some reversion of that, maybe moving to index weight, could lead to very large inflows into the UK market, and clearly in the small cap space that could be very positive. Just moving on to summary, I guess, of the above. I've talked about the valuation picture, which we think is incredibly attractive. Buybacks are a relatively new phenomenon to the UK small cap space, but it's been going on across the UK market, and it is really an indication of both the valuations that we're seeing across the UK market, but also the strength of company balance sheets. Corporate balance sheets are actually in very good shape. They've all been mindful of interest rates rising, so have been strengthening their balance sheets and are actually managing to invest in their businesses, but also buy back their shares, which are trading at these lowly valuations. Again, the macro data, as I say, is trending much better than market expectations, and many of the lead indicators are also incredibly positive. Mergers and acquisitions have been a huge part of the UK market in the last couple of years. We talked about it a lot last year, but actually this year has been even more ferocious. The level of M&A activity is up 60% year to date versus last year. And again, that is because there is plenty of cash on the sidelines. UK market is incredibly cheap, and we are continuing to see bids across a range of sectors, both from corporate buyers and financial buyers. Actually, interestingly, this year it's more corporate buyers. We've benefited in the fund in a number of instances, the likes of Redrow, for example, Virgin Money, IQ Geo, Alpha Financial Markets, and potentially Equals Group. So we were less fortunate last year. We only had one, sadly, from all of the bids that took place. But I think it provides obviously a boost to valuations in the UK market, and also when those bids complete, it can lead to money being recycled back into other names and then helping the valuations of other companies. Regulatory change has been talked about by all political parties, and we've obviously heard talk about the British ISA, which is not, I don't think, going to lead to huge inflows into the UK market, but is positive for sentiment. There are a number of government papers looking at the allocation of UK pension funds to UK equities, and again, the mood music here is certainly more positive. Perhaps a collapse of the listing rules as well, to enable investors to continue to be able to invest in companies that have moved their primary listing, should also be beneficial for the UK stock market. Just moving on to the trust itself. So this is the summary. So I talked about the benchmark, numerous smaller companies plus AIM. This has over 1,000 companies within this index. At the top, it's an annual rebalance. It tends to be around 1.5 billion, and then obviously through the year, companies will rise in market cap or form perhaps. Company assets you can see here. Part of that is a result of the merger we've recently had with our mid-cap investment trust that Georgina and I also managed. And this was really because there was a significant overlap in the trusts. It's important to have scale and liquidity as well in terms of investor base. And this completed in February this year. The focus really here is to maintain a UK small cap focused investment trust. We have added a few stocks that were held in mid-cap, but just a handful. One of those was actually Virgin Money, which, as I say, received a bid, so that was incredibly timely. But the idea would be to retain our small cap bias in the market because we think there is a very exciting opportunity to continue to find exciting investments there. The gearing range you can see here. Typically, the board set a slightly narrower band, and that is typically been around 10% geared at the maximum. We are very close to that at the moment. We actually have quite a long list of stocks that are on our watch list, and it's really about relative pecking order in terms of getting into the portfolio. So we don't have a tail of stocks in the portfolio. We do like to run our winners and cut our losers quickly. But reflection of that gearing being very high is the opportunity set that we find ourselves with at the moment. The discount as of today is actually just over 6%, and that has been moving in, I think, post the merger, and the performance recently has led to that coming in. Hopefully it'll get even narrower than that, but we think we're in a good position there. The board have done buybacks in the past when the discount moves out, and is certainly out of line with peers. The board have also moved to an enhanced dividend policy here. 4% of NAV paid quarterly. So the financial year end for the trust is the end of July. So based on the NAV at the end of that period, will then determine the payout for the coming quarters. There's no change in the way we look at the portfolio. The board have been very clear. Our focus really, as you'd expect in smaller companies, is looking for companies with capital growth. I'll talk a little bit about our process shortly, and you'll hear in there cash flow is very important. So actually the natural dividend yield off the portfolio is about 3% anyway, and that has been up there very consistently. You can see on the right hand side as well the performance over the longer term. We did have a slightly trickier 2022, particularly with the Russia-Ukraine situation. In the first half of that year, we had a tough year. We did change the portfolio slightly, but also use that opportunity where you have situations where the macro is driving the stock market, and there are huge dislocations in the fundamental value of companies and their share price. We do try and take advantage of those opportunities. And we've got a very disciplined framework in terms of how we invest and how we look at things. And as I say, we're trying to invest for the longer term. Many of the companies have been in the portfolio for many, many years. So we will try and use those periods of dislocation to take advantage. And I think that has benefited us in the last year and a half since then, as you can see from the excess return over the 1 year period. In terms of the investment philosophy, so really the idea is at a very simple level to have a portfolio that is cheaper than the market, higher quality than the market, with a more positive outlook than the rest of the market. And there are a number of metrics that we will scan our universe on. We will then spend time focusing our attention on certain stocks that flag up based on the metrics we're looking at. We will use our internal analysts. So we have a team of 9 UK fund managers, 6 focused on small and mid cap. So we can use the team there. We'll also use external brokers for their research. Do lots of management meetings as well. I think it's very important in small cap, and it's not just a one-way conversation from management. It's very much two-way, and getting across what we also expect of management in terms of longer term focus, capital allocation, discipline, etc. Ideas around governance and all of those great things. So it's very much a two-way conversation. Site visits also an important part of what we do. And then it's very much a bottom-up stock-led portfolio. Clearly, we're mindful of the macro and need to be, but it's very much stock-led. There are huge opportunities in our index to look domestically, but also internationally. The revenue mix for the numerous smaller companies plus AIM is about 55% domestic and the rest is international. So huge opportunities on both sides. In terms of the portfolio, then what is important is it comes together in creating that cheaper, higher quality with a positive outlook. And some of the key metrics we look at are here. So the free cash flow yield of the trust. So this is how much cash is being generated by companies as a percentage of their market cap. This is incredibly high for a small cap, both index and trust. It's as high as I've seen it since I've been running this trust in the last 11 years, which just gives you an idea of where valuations are. But it's 6.2% free cash flow yield, and that's after companies have been spending money on investing in their businesses. In terms of the return on invested capital as well, again, a huge delta between the index, which is a good indication of the efficiency of the companies that we're investing in and how efficient they are investing capital in their businesses. And then in momentum, a key indicator we look at is the change in earnings forecast for these companies. On a 3-month basis, you can see the trust has been getting upgrades. So despite, as I say, all of the negative media headlines around the world about how tough it is out there, we are still finding companies that are doing better than market expectations and getting earnings upgrades. And that's against the index, which is seeing small earnings downgrades over the last 3 months. But let's say, so it's very much stock-led. But what is important at the portfolio level, it comes together like this. But let's say these metrics are about as attractive and stark as I've seen them since I've been running this trust. Some of the key drivers of performance here, and I won't dwell too much on these. Clearly, we do get things wrong, but I'd say the philosophy here is really to exit and move on, because we do have a whole host of other opportunities to invest in. So a couple in here, CAB Payments, which was an IPO, but disappointed at their second set of earnings due to fluctuations in currency. They were overseas payments operator, and that was a very easy decision, sold on the day of that warning, and we move on. Big Technologies, again, very interesting company which provides ankle tags for prisoners and monitoring. Again, a high quality company in terms of returns on capital and margins, but clearly suffering in terms of being able to expand into new geographies. Was a small position because it wasn't proven yet. It was only a relatively recent IPO. Disappointed, so again we exit those companies and move on. But I think what's also astonishing on the other side, where we do have conviction, to see the relative weight in the portfolio here. There are companies which we have perhaps taken at IPO and grown in the portfolio over time, and where we have that conviction and where things are coming together nicely for the company, you can see huge stock returns in this part of the market. So, and it's not just one-offs. There are, as you can see, 3 companies here with a stock return in a year of over 100%. And this is the beauty of investing in this space. You can find companies that will go up 5, 10, 20 times. For example, in the past, we have owned JD Sports and Ashtead in this portfolio. They're companies we've known for many, many years, own them when they were small caps, and you can ride that journey with them to becoming large caps. So it's a wonderful place to be investing in. Just moving on to some of the changes to the portfolio you can see here. So on the sell side, typically companies that are perhaps empire building, taking on too much debt, slightly concerned about the outlook with too much debt is a no-no for us, and exit those. Ergomed was our one takeover that we had last year at about a 35% premium. Workspace in the real estate arena, flexible office space, which we thought was just taking a bit longer to get back to where we hoped it would. Another exit, but nothing significantly negative about what's going on there. On the other side, new opportunities in all different sectors. So MJ Gleeson, a northern-focused house builder, average house price that they sell their properties at is around 140,000. Huge land bank as well, very high operating margins, high returns on capital, very strong balance sheet. and has got a huge opportunity, I think, ahead of it. Again, talk in both sides of government is to free up regulation, perhaps release land bank, and that we think could be very beneficial for the house builders. It's an area we've been adding to in recent times, so the likes of MJ Gleeson, the likes of Redrow as well. Volution, which is probably the second derivative of that, and next time you're in a bathroom, have a look up, and if you see a Vent Axia brand, that is owned by Volution. So they provide ventilation systems into some residential properties and commercial properties. It's a global business, UK, Europe, also Australasia. High operating margins, high returns on capital, very strong free cash flow generation. And despite pretty tough markets, particularly in the RMI market in the UK and Europe, this is a company that's been seeing earnings upgrades. There's huge amounts of focus on the quality of air, particularly in social housing, but also in private housing, and that is leading to very strong demand for their products around the world, and that has led to very strong earnings upgrades. So that's a position we've been increasing significantly. Paragon buy-to-let lender, again, a market that has been pretty stagnant in terms of volume going through it, but actually Paragon and also OSB, which we own in the portfolio, benefiting from other providers pulling out of this market. It's a specialist market. There are now really it's focused on landlords who have multiple properties at the professional end who do it as a living, and that focus on specialist lending is driving business towards the likes of Paragon and OSB, who are both generating very high returns on equity, very well capitalized, and also returning lots of cash to shareholders in the form of both dividends and buybacks. And then finally, Hostelworld, a booking app, so technology company. There are many of them on the UK stock market, but even so in the small cap space, a booking app that allows travellers to book hostels all around the world. It's gone through a management change, and they've been able to invest in their business rather than focusing on the commission they're taking from the hostel owners. And that has led to a significant uplift in usage. They're driving the social side of it, the networking side, so they almost have a social media platform again, which has led to earnings upgrades, incredibly attractively valued as well. Final slide I was just going to refer to. So let's say the index and this part of the market is an incredibly exciting area to be invested in. For small cap fund managers as well, there are opportunities to significantly exceed that, and this is the track record over the last 15 years or so, going back since when Georgina took over this trust. It's a very similar picture. There is an opportunity to generate significant amounts of alpha and returns by investing in this part of the market. So with that, over to you, Roland.
So just briefly, can you just confirm that the range, the market cap range, how small do you go, how large, and what's the weighting to AIM?
Yeah, so we'll start investing about 100 million, and that 100 to 200 million is a real sweet spot there. I don't think there are many fund managers looking in that part of the market. At the top end, the annual rebalance is 1.5 billion. We can hold stocks once they've been promoted out of the index, but then we won't typically add to those names. And then in terms of AIM, the index weighting, it's about 30% AIM within the Numis plus AIM, and we're about 35%, so about 5% overweight to AIM currently.
I had a few questions about the merger and the portfolio post-merger, and I've picked this one out because it sums it up quite nicely. And with that merger completed, are there changes still needed to reach your target portfolio? Will the balance between small and mid caps in the trust vary over time?
So I'd say 99% done. There are a few tweaks here and there. We are holding a handful of mid-cap stocks that we wanted to own because we think they're incredibly exciting opportunities. Over time, you would expect those to perhaps exit the portfolio and be recycled back into the small cap space, but it will be very much a small cap focused vehicle. No change from what we were doing previously.